And that's
Yeah.
what we've seen here over, the last several months. It's kind of just ground higher and higher, and people get a little disgusted. It's going sideways. Oh, it can't get above 35. Oh, man, 35 is it. Oh, 35, 35, 30. And then all of a sudden it's 37, staying there. And then, so this is what I expect.
The Financial Survival Network. Now more than ever.
For decades, silver has carried with it an air of mystery, suspicion, and controversy. It is one of the most vital industrial metals on Earth, used in everything from solar panels and electric vehicles to medical devices and military technology. At the same time, it has been money for over 5,000 years. Yet in the modern financial world, silver often looks more like an orphan asset than the indispensable resource it truly is. Its price movements are erratic, often disconnected from supply and demand fundamentals, and riddled with sudden collapses or violent spikes that leave retail investors bewildered. This paradox has fueled a persistent suspicion. Is the silver market manipulated? Few voices have done more to explore and expose this possibility than David Morgan, founder of the Morgan Report and long known as the Silver Guru. For more than 20 years, Morgan has warned that the forces shaping silver prices extend far beyond the simple economics of mining supply and industrial demand. He has consistently argued that structural manipulation exists within the financial system, particularly in the futures and derivatives markets, that artificially suppresses silver's price to the benefit of large banks and the detriment of ordinary investors. But the real story is deeper. It's not only about Wall Street traders pushing contracts around, it is about silver as the Achilles heel of the entire economic system. For if silver were to trade freely, reflecting true fundamentals, it could expose the fragility of fiat currencies, central banking, and the leverage-driven system of global finance. This is the unspoken truth at the heart of the silver market. And as David Morgan has long suggested, the day may come when that truth can no longer be hidden. David Morgan's reputation was built not just on price calls, but on his ability to connect dots most others ignored. When mainstream financial media dismissed silver as a volatile commodity best left to speculators, Morgan insisted that it deserved a central role in any honest discussion about money and markets. His early warnings focused on several key themes: predictions about market forces. He noted how silver tends to lead in both bull and bear markets, acting as a forward-looking indicator of broader economic stress. The dark pools of silver, long before the term was fashionable, Morgan emphasized that a significant portion of silver trading occurs in opaque over-the-counter markets. These are transactions between large institutions hidden from public scrutiny, where real supply and demand dynamics are masked by layers of derivatives and settlement tricks. Whistleblowers and insiders, perhaps most important, Morgan gave a platform to those who confirmed what retail investors had long suspected. Former traders at major banks admitted that spoofing, naked shorting, and concentrated positions were common. Some of these practices even led to regulatory fines years later. But by then, the damage had been done. The price suppressed, confidence shaken, retail investors burned. For Morgan, the takeaway was clear. Silver was not simply a commodity. It was a battlefield where truth and deception collided, and behind the curtain were financial entities with both motive and means to keep silver's price under wraps. How exactly could silver be manipulated? To the casual observer, it might seem impossible. After all, silver trades on global exchanges, its supply comes from dozens of countries, and demand is spread across countless industries. Surely such a market is too big and diverse to be controlled. The answer lies in the futures markets, particularly the COMEX in New York. Unlike physical silver, which must be mined, refined, and delivered, futures contracts are simply paper promises. For every ounce of silver that physically exists, there are dozens, sometimes hundreds, of ounces represented in futures contracts. This creates what analysts call paper silver, a supply of virtual ounces that can be created or destroyed with the stroke of a keyboard. When a small group of large banks holds concentrated short positions in these futures markets, they effectively control the price. By flooding the market with contracts, they create the appearance of overwhelming supply, pushing the price down. Retail investors and smaller funds, seeing prices collapse, panic and sell, reinforcing the downward move. This dynamic has played out countless times. The Hunt brothers, 1970s, 1980. Two Texas oil billionaires tried to corner the silver market by buying physical supply and futures contracts. Prices soared to nearly $50 an ounce. The establishment responded by changing the rules, banning new long contracts, and crashing the market. The lesson was clear: when silver rises too far, too fast, the system will intervene. The JP Morgan era, 2008-2016, regulators eventually fined JP Morgan for spoofing, placing fake orders to move prices in precious metals markets. The fines were small relative to the profits. The larger issue, however, was the bank's massive concentrated short position in silver futures. At times, a single bank controlled more short exposure than the entire physical supply mined in a year. Flash crashes and waterfalls. Investors have witnessed silver drop by multiple dollars in a matter of minutes during thinly traded hours, with no news to justify the move. These waterfalls are consistent with coordinated selling of large futures positions designed to trigger stop-loss orders and shake out weak hands. For David Morgan, the conclusion was unavoidable. Silver's price is not solely the product of supply and demand. It is the result of a managed system designed to protect the credibility of fiat money by keeping precious metals in check. Skeptics often ask, even if manipulation exists, so what? If I can buy silver cheap, isn't that good? The answer lies in the broader consequences of suppressed prices, impact on miners and supply. When silver trades below the cost of production, miners cut back on exploration and development. This creates a supply deficit that builds over time. Already, much of the world's silver comes as a byproduct of mining for other metals like lead, zinc, and copper. Without new primary silver mines coming online, the industry risks chronic shortages. As Morgan has said, this creates a ticking time bomb, a structural imbalance between real demand and constrained supply. Impact on retail investors. Retail investors face the constant struggle of buying into a market that feels rigged against them. Weak hands are shaken out during every engineered sell-off, while strong hands who hold physical metal are rewarded over the long term. But the psychological toll is significant. Many give up on silver altogether, believing the manipulation will last forever. In doing so, they miss the once-in-a-generation opportunity that suppressed prices create. Geopolitical implications. Silver is more than an investment. It is a strategic resource. From solar energy to electronics to defense applications, its role is expanding. When prices are artificially low, industries may take silver for granted, failing to secure supply chains. Meanwhile, nations that recognize silver's importance, such as China, accumulate physical stockpiles quietly, preparing for the day when true scarcity becomes undeniable. In this sense, price suppression is not just a market issue, it is a matter of national security. For the everyday investor, silver presents a paradox. On one hand, it is undervalued, manipulated, and frustrating. On the other hand, that very manipulation creates the setup for explosive upside once the system can no longer contain reality. David Morgan often speaks of the difference between weak and strong hands. Weak hands chase rallies, panic during crashes, and ultimately sell at the worst possible time. Strong hands accumulate steadily, ignore the noise, and recognize that physical silver held outside the system is a form of wealth insurance. This dynamic explains why silver investing feels like swimming against a powerful current. It is designed to exhaust you, to make you quit, but those who endure find themselves in possession of one of the most asymmetric opportunities in finance. If silver is manipulated, how will it end, and how can investors prepare? Morgan points to several key indicators. Rising industrial demand as solar panels, EVs, and AI-driven electronics proliferate. Physical demand will outpace available supply. Paper games cannot deliver actual ounces to factories. Physical shortages, premiums on coins and bars serve as an early warning. When retail dealers run out, or when industrial users face delivery delays, it signals stress in the system. Geopolitical shocks, trade wars, sanctions, or military conflicts can disrupt silver flows, forcing countries to scramble for secure supplies. Loss of confidence in fiat, inflation, debt crises, or banking panics often drive investors back to precious metals. Silver, being more accessible than gold, becomes the people's hedge. For the investor, the strategy is straightforward, but psychologically challenging. Accumulate physical silver steadily, diversify into quality mining stocks, and ignore short-term volatility. The goal is not to trade every move, but to position oneself before the unveiling occurs. The ultimate question, as Morgan frames it, is this: is the unspoken truth about silver's suppression about to become the market's undeniable reality? History shows that manipulation works until it doesn't. The longer prices are held below fair value, the more violent the eventual revaluation. Consider housing bubbles, currency pegs, or interest rate caps. They all share the same pattern: artificial stability followed by sudden collapse when reality asserts itself. Silver is no different. A genuine revaluation could take silver from current levels to multiples higher in a short period. Whether that means 50, 100, or beyond is impossible to predict precisely. But the logic is simple. Once faith in paper contracts erodes, only physical ounces will matter, and there are far fewer of them than most imagine. The domino effect would be profound. Mining stocks would explode in value. Industrial users would scramble to secure supply, bidding prices higher. Governments might impose export restrictions or even confiscate domestic production. Investors who held physical silver would find themselves not only wealthy, but also in possession of a form of money outside the financial system. This is the shockwave David Morgan has long warned about. And while no one knows the exact timing, the structural setup is already in place. At its core, silver is more than a metal. It is a truth test for the financial system. When prices are suppressed, the message is that the system is still in control, still able to dictate perception. But when silver finally breaks free, it will reveal what lies beneath. A mountain of debt, leverage, and fiat promises that cannot be kept. David Morgan's decades of research, warnings, and advocacy boil down to a simple insight. The truth will out, and when it does, silver will not just be another investment. It will be the revelation that exposes the fragility of the entire economic order. For investors today, the choice is clear. You can ignore the whispers of manipulation, dismiss silver as a fringe asset, and hope the status quo continues forever. Or you can heed the warnings, prepare for the unveiling, and hold the metal that history has always turned to in times of crisis. Silver is the Achilles heel, and sooner or later the arrow will find its mark.